So now we are in chapter 9, and this one we come change gears a little bit. We get into business income deductions and accounting methods. So we're looking at sole proprietorship. So they're not incorporated, not partnerships. And I'm going to talk about Joe. It's one of the problems in your book, and just kind of, again, terminology and kind of a video lecture going over what's in the chapter by utilizing one of the problems. But this is a business. Doesn't really matter what it does, honestly, but we do need to know what kind of accounting method they use, and he is accrual based, and there's no there's no inventory, and we're trying to determine if these transactions result in taxable income. And so you've got a client named Joe. He signed a contract, and the contract provides that the sales are dependent upon a test sample. He's delivered $12,000 worth of the gadgets that won't be tested until March. And he purchased these gadgets for $8,500. So he's going to have a profit, you can see, of $3,500. But the question is this included in his taxable income for the year in which the transaction took place? So the answer to that one is no, because the sale is contingent upon a future event. And so until that future event takes place, there is zero taxable income. Contingent upon future event. Now, remember, he's an accrual basis taxpayer. That's important. Joe paid $180 for entertaining, keyword, entertaining a visiting out-of-town client. The client didn't discuss business with Joe during this visit, but Joe wants to maintain good relations to encourage his business in the future. That is a zero deduction. Entertainment is no longer deductible. Terminology. On November 1st, Joe paid premiums providing for a $40,000 of key man life insurance on the life of Joe's accountant. Accountants are very important. However, insurance premiums on a key man policy are not deductible because any life insurance proceeds paid would be tax exempt. And so you have to look at the offset. So it's a zero deduction, life insurance premium not deductible. And again, it's because if they do collect on that, the life insurance would not be taxable. Therefore, the deduction is not taxable as well. At the end of the year, Joe's business reports $9,000 of accounts receivable. He thinks he'll bring in at least $7,000 of this. He thinks $2,000 of it is going to be uncollectible. So basically, what Joe's got is a $9,000 increase in income. Now, in Intermediate 1, and actually a little bit in financial accounting, we know that we estimate our bad debt expense, and we go ahead and match that with our revenue. But in tax, we do not. And so you can't take those bad debts until they actually happen. Next one. In December, Joe rented equipment to complete a large job. He paid $3,000 because the rental agency required a minimum rental of 3 months. He completed the job before the year end, but he returned the equipment at the end of the lease. So he completed the job, but he kept the equipment. So the question is, how much will he deduct? And so we look at economic performance rules. So he's going to deduct it over the lease of the term. So even though he finished the job, he had it where he could earn. So he's going to have to spread that out. So he takes $1,000 deduction in year 0, which is the year we are working on, and then he'll take the additional $2,000 deduction in year 1, the next year. He hired a new sales representative and sent her to Dallas for a week to contact prospective out-of-state clients. He ended up reimbursing her $300 for airfare, $350 for lodging, and $250 for meals. And there was they substantiated the business purpose for the meals and asked the employee to account for all business expenditures. So Joe is allowed to deduct the full cost of the airfare and the lodging. However, he only gets 1/2 of the meals. And so he can deduct the $300 airfare, $350 lodging, and 50% or $125 for meals. Meals are limited, 50% in this particular case. Got a BMW. It's his personal auto. He travels to and from his residence to the factory, which is where he works. He often switches to a business vehicle he needs to travel after he reaches the factory. But last month, the business vehicle broke down and he was used his personal vehicle to travel to and from work sites. He drove 120 miles visiting work sites and 46 driving to and from the factory from his home. He uses a standard mileage. So the 46 from home to his factory is personal. That is not deductible. But he can do mileage for the 120 miles. So he can take the 120 miles times the mileage rate, which is 58 cents for 2019, and he can deduct that as a travel expense, but not the travel from his home to the factory. And then the last one, Joe went to visit his parents in Dallas. While he was there, he spent $50 on a business symposium, paid $200 for airfare and $50 for meals during the symposium, and $20 for cab fare to the symposium. So you have to look at the primary purpose. The primary purpose was to visit his family over the Christmas holidays. Again, it goes back to intent. And so his intent was to visit his parents, and while he was there, he went to a symposium. So he can deduct $25 for the meals while he was at the symposium, $20 for cab, and $50 for the cost of the symposium, but he cannot deduct the travel because it was not his primary purpose. And so $50, and then he can also deduct $20 for the cab fare. So lots of information in this chapter, and you're just going to have to look up each one of those expenses. They give you lots and lots of examples throughout the chapter. It's, again, you have to look, is it reasonable? Is it necessary? What was the intent with the expenditure? They list some common ones on page 3: advertising, car and truck, depreciation, employee compensation and benefits, insurance, interest, legal fees, office expenses, rent, repair, supplies, travel, utilities, wages. There's others. Some people, like internet will be lumped into utilities, and sometimes it's separate. So, and then again, these key facts, make sure that you're looking at those key facts and remembering. These are items that I've said to you, when you walk out of here, these are the things you need to remember. So, for example, no business deduction is allowed for expenditures against public policy or bribes or our political contributions. Expenditures that benefit more than 12 months generally must be capitalized. No deductions are allowed for expenditures associated with the production of tax-exempt income. Personal expenditures are not deductible. So these key facts, again, are just a really good place to go back and review after you read the chapter and get a feel for the content. Then it's a good idea to go back to those key facts and make sure you remember those items.